growth recession. Now before this, I want you all to pay very minute attention in understanding this one. See, in this diagram we have something known as recession in the economic cycle. Let us understand how recession occurs. Now say, if I take on the x-axis the parameter of time or the number of years, and on y-axis the economic performance, say it can be a GDP, right? And we have the origin here, that is a 0 here. Anything above is positive, anything below is negative. So this is the simple axis we are taking. And on this axis, we are plotting the GDP of a nation. Say GDP is on this level, that means GDP is not growing at all. For example, now say the government is investing too much, the banks are investing too much, there are more business establishments which are going on. So it is doing what? It is increasing the goods and service production in the country. So GDP is increasing. Now to have more and more goods and services, you need more and more employment of the people. Now employment is also increasing. This is showing the growth of the economy. When the employment is increasing, we have to understand that people are also spending more. Spending more on what? Goods and services. So the demand for goods and services is also increasing, right? So the demand for goods and services is increasing, companies are increasing the production, employment is increasing, profits of the companies are increasing, they are furthermore doing more investment. Again this cycle is going on. So with respect to any investment, it is already observed that the growth of any economy occurs. But the thing is that in an economy we have limited resources. Won't you agree? In life also we have limited resources, right? So in economy also we have limited resources. That means, say the amount of coal that we have, say the amount of water that we have, so the amount of agricultural seeds that we have. In short run, don't you agree? In short run, or say in the span of say 2 months, 3 months, that is very limited. That is very limited. And if the demand is so high due to so high growth, it will be putting pressure on these existing stocks of supplies. Even the companies, they also have some limitation with respect to their infrastructure. They cannot all of a sudden overnight build in machines, right? So we can understand that with growth, there is also inflation because there is high demand with comparison to less supply in the market. So growth brings in inflation, and when there is inflation, let me tell you, the RBI will be very angry, right? They will be very angry. They will be intervening in the market. They will be intervening in the market and say that now the people are actually spending more, and that is why inflation is happening. And RBI is one of the important roles is to decrease the inflation in the markets, right? So the RBI will say, okay, now I will do a very strict punishment. I will say that people, you cannot spend more because you are hurting the economy. There is more inflation in the markets. Poor people are getting poorer. They cannot afford essential items, while the rich people can afford. And also there are many other effects also. Inflation can also lead to depreciation of the economy. They can indirectly also lead to deficits in external balances of the Indian economy. So it has many bad effects if the inflation is too high in the economy. So RBI will say, okay, I will be increasing the interest rate, I will be increasing the repo rates. So what we'll do, when the interest rates are too high in the economy, what is the case here? It is the case of reducing the money supply in the economy. Because if high interests are there, people will not be taking loans. The private sector will not be taking loans, they will be not doing any investment. And if they do not do any investment, the employment will fall, the GDP will fall. And this is what, at the peak, when RBI intervened, increase the interest rate, the economy is falling. And there can be two approaches of increasing the interest rates. One, I can say that if the inflation is as high as say 10%, and RBI said, okay, I will be giving a very severe punishment. I will be severely punishing that. I will be all of a sudden in one night only from 4% interest rate, I will be increasing to 6%. 2% increase in interest rate is very high. Is very high, let me tell you, right? No one actually does this. On the other hand, I can say I will gradually punish. I will be gradually punishing you. I will be slowly punishing over days, right? That is, firstly, I will be saying that interest rate from 4% it can be 4.05%. Then I can say it will be 4.06%. So gradually I will be increasing the interest rate, so that instead of this line, instead of this steep line, I can ensure that it follows this line also, right? Or the thing that we can understand, RBI can intervene quickly. RBI can spot those signs of inflation early from here itself and intervene at this peak. So inflation was not that high, and even if the economy reduces, employment will be reducing, people will be reducing, losing their jobs, people will be hurt. So if I detect the inflation early, I will be also able to reduce the number of jobs lost also. See, jobs will be lost here also, right? There is inflation, RBI will definitely intervene, jobs are lost here also, but more jobs will be lost in this way. So this is actually what is known as a soft landing. If you have ever been on an aircraft, right, flights, you can understand that when the pilot is preparing for landing, we can understand how good the pilot is, right? We can understand when the plane is just landing and it is touching the runway, when the wheels just touch. If we do not feel any fluctuations in the flight, or if you do not feel any vibrations, wild vibration, that means the pilot is highly experienced pilot. If we see that there is too much jerks and jumps while the plane touches the runway, we definitely will be concluding that the pilot is not a good one. He is not experienced, or she is not experienced, right? This is the same case here, because we have to understand when the central bank will be intervening in the economy, it has to do a very soft landing. It has to do a very comfortable landing for the people, so that even when the economic growth due to this goes negative, in the negative quadrant, in the negative way, or when economy is in a recession. Recession is actually a situation of low growth for 2 consecutive quarters, or for these 2 consecutive quarters the GDP did not increase at all, or say it was below this negative value. So when there is recession in the economy, we have to understand we also cannot go this below. The RBI have to ensure that it stays above, right? So this is the case of growth recession. That means even if the economy is in a recession, there can be some positive economic growth also, right? To understand this, let's have this thing in the background. And also we have something known as potential growth rate of any economy. It is also known as potential GDP. And actually this question came in 2020 mains. So it is very important to understand what is potential GDP. We understand what is GDP. But what is potential GDP? It is that rate of GDP growth where an economy can grow without spiking inflation, right? It can grow, the economy can grow, but it cannot lead to increase in inflation, because more and more higher inflation will ultimately lead to later reduction in employment opportunities, because more inflation will be bringing recession, right? So this is the thing. That means US has a potential GDP, for example, to increase its GDP by 1.8% every year. It is a combination of increased productivity and the changes in the labor force. So potential GDP factors in inflation, the productivity that can be dependent on the technological experience, right, and the capital that the country has, and also the quality of labor, or how skilled or how less skilled the people are. So it is depending on these, potential GDP is dependent on these things. And here growth recession, we have to understand, is that thing. We have to understand here that in the US, the Standard & Poor, which is their stock market indicator, and the Nasdaq 11 have registered remarkable gains over the last 6 months despite slowing GDP, right? It is due to the fact GDP is slowing, but potential GDP is performing well. It is reliant from the stock market performance. Correct? It was actually expected at the end of 2022 that the US will be in a recession, that most of the global economies will be in a recession, but it is not so far. Right? Then we have to understand that a big reason for such fears was the central bank's action, because most of the central banks were increasing the interest rates. And when the interest rates increase, the demand declines in the economy and the economy slips into recession, as discussed before. But the thing is that this is not the case right now, right? And when the interest rates rise, we have to understand the stock markets tend to suffer. Why? Because the investors feel that they cannot invest right now. So they right now keep their money in just own bank accounts other than investing, right? Then we have to understand it will also lead into less employment. So this in turn reduces the incentive to lend. But the thing is here that US is being seen growth recession. Growth recession is something which is above zero but below potential. That means the potential GDP of the US has been quoted as 1.8%, and if the country is facing recession, that means it has to remain below 0%. If a country is growing in this range, that is between their potential GDP and the 0% GDP growth, which is not growing at all, this is actually what is known as growth recession. That means the economy is almost close to recession. It is growing very slowly, but it is actually closer to potential GDP also, which is the bare minimum growth that can happen. So US economy is at 1%, which is in this range. So that is why it is known as growth recession. Now, can we say this is the same condition in India? No, because this is not the same condition in India which is going on right now. We have to understand, during 2009 financial crisis, India's potential GDP was around 8%. But this potential GDP is decreasing over a period of time, especially between 2016-17 when demonetization took place. The potential GDP decreased because there was inflationary conditions, right? There were less amount of skilled people, capital, technology is kind of less in India also, right? But the thing is that India have more potential to increase. That is why it is higher than the US, right? In the coming future, if India can use its demographic dividend resources efficiently, it can increase in the future, right? So this is the thing, this is the case of India. But here, there can be some warning signs also, because just after the pandemic, India's economy has grown faster, right? It has grown faster, giving India the tag of world's fastest growing major economy, correct? But the thing is that this fastest growing tag can also be attributed to a low base effect. For example, say in 2020 when corona pandemic hurt, actually the economy shrank very high. For example, say the total GDP was 100 rupees in 2020. In 2019, however, the economy was at 110, right? Economy was at 110. So due to corona, it is expected that economy will reduce. But in 2021, due to lifting of lockdowns, economy clocked at 105. That means this is a 5% growth over the last year. But if we see, it is actually reduction of 5% from 2019 levels actually. So if we take 2020 as base and not 19 as base, we can always have a higher value, right? If you take a low base, it will always give a higher value to us. So this is the thing. Then growth rates have started decelerating again. For example, in the financial year 2020-22, it was 9.2% to 7.2% in financial year 2023. So it can be said that India can also face a recession in the near times, but it is not likely in the near future, right? Also, the stress in the labor market is visible because there are high rate of unemployment rate in India also, and consumption levels of also Indians have decreased. So these are some of the indicators, but don't worry, India is not going into recession in the coming future, because India's demand and India's consumption level, especially in this festival seasons, in the coming months, that is expected to improve. And even the inflation in India is also coming down over a period of time.